Hi, I'm Devin and welcome to this week's Money Minute. Now, over the last few weeks, we have been unpacking the biggest behavior risks that can destroy your long-term wealth as an investor. We've covered the dangers of trying to time the market and the trap of chasing past performance. Today, we're going to look at the third and possibly most destructive risk of all, and that is letting your emotions dictate your investment strategy. Now, I know we all like to think we are rational beings and generally in control of our emotions. However, it's often when it comes to our money that it reveals how emotional we can be. And there are two dominant emotions when it comes to investing: fear and greed. And when markets fall and we see the value of our hard-earned savings move lower, fear naturally takes over, tempting us to sell and flee to safety. Conversely, when markets are booming, greed kicks in, tempting us to take on reckless risk just as it feels like everyone else is making more money, and usually at the wrong time. Now, these emotional knee-jerk reactions derail long-term financial legacies faster than any economic recession ever could. In other words, you can be a bigger risk to your investments than any war or economic shock. And this is exactly why having a trusted financial advisor who builds and maintains a financial strategy for you is so important. We do the heavy lifting behind the scenes, ensuring your portfolio keeps working towards your long-term goals rather than reacting to the daily news cycle. Great advice isn't just about managing money, it's about managing behavior and keeping you on track during the noisy times. And data shows this. Clients who have a trusted advisor outperform those who do not for this exact reason. So stick to the plan, ignore the noise, and let compounding work its magic. Thanks for watching. Have a great week.